yield curve is, as we say, it's often doubted, but rarely, if ever, wrong. So pay attention to the inversion. But obviously, what's most important this week is going to be what's happening with the Fed. And we do expect a dovish hike. So right now, the Fed is forecasting a hike in December. The market's on the same page as that. The Fed's also been saying 3 hikes next year, and the market has now faded the Fed to less than 1 hike. There's about a 50% chance of 1 hike in the markets right now. So expect a dovish meeting this week. Expect the Fed probably to move from 3 hikes next year down to 2. So expect the dots to drift lower, and we expect that should help market sentiment right now, which has been weak.
Rich, your take is that this really scares me because you say this is one of the hardest markets in your career to get a handle on, and that goes back a ways. I mean, this is that's
32 years, Joe.
That's saying something. And there's been a lot of scary markets over the past 32 years. What's different about this one that has you scared?
Well, I think it's a combination of the speed in which information travels and then how it's traded, right? So, and I'm talking about both up and down. When you have markets that are really cloudy like this, and you have news flow in the morning, and then all of a sudden you have these enormous swings, it erodes confidence in both the public markets, and it also makes people skittish. Our concern is that could lead to some self-fulfilling prophecies of slowing consumer demand and things like that. But I think right now, Joe, that we have to let some of these data points get through so that it becomes less tough. You know, the Fed news will come out, and we think we're one and done for a while. And I think any type of news that could be less worse could lead to some rally in this market. The New York Times had unbelievably pessimistic stories and headlines. That's a positive data point for us. Is it the BIS that came out and said volatility is back? In 32 years, I've never even heard them make a statement on this. So we're starting to collect these data points of pessimism that maybe will make it a little bit easier.
Matthew, do you see this piece, Druckenmiller and Warsh? I don't know whether you got a chance to read it this morning. It's in the Journal, and we hear some of Druckenmiller's comment, and Kevin's written a lot of op-ed pieces in the past about raising rates, about not staying at emergency levels for too long. Their take at this point seems to be that the time was past. In fact, that by staying at the party for too long, staying at zero for too long, it's made it much tougher at this point to start hiking. And they say right here, central bank should pause its double-barreled blitz of higher interest rates and tighter liquidity, and that the markets are telling us something. Stock markets, equity markets, bond markets, all telling us that this is not the time to get too tight too quickly.
So if you listen to what Powell says, and I usually point people to his Jackson Hole speech, he's actually great, plain English spoken. He's not overly quantitative. He's sort of humble and modest about monetary policy. He doesn't think you have to really follow the models. And he'll say, listen, in a crisis, when you need to act fast and do big things, that makes sense. But otherwise, be gradual, be incrementalist. So if you look at what he says, now is the time to sort of put those words into action. And now might be potentially a good time to make a pause. If you think about not just the fact that we've gone from 0 to a 2 1/8 on Fed funds, if you look at what the Fed used to publish called the shadow rate, which used to take into account both the Fed funds rate and how much quantitative easing it affected rates, essentially you got to a rough number of about -3% the Fed funds rate. So it's been a big move up if you think of that -3% as the shadow rate up to 2%. Effectively 500 basis points of rate increases significantly affects the economy, and you're seeing that. You're not seeing the end of the cycle, but you're definitely seeing later cycle behavior in housing, which is rate sensitive, in autos, which is rate sensitive. So if Powell's approach is to be gradual when it makes sense, then moving from 3 to 2 next year, as we expect the Fed to do, and a pause in this cycle probably makes sense.
I mean, this is not really a bearish piece at all. In fact, the last paragraph is, this is a time for choosing. We believe the U.S. economy can sustain strong performance next year as long as there's no major policy error, which is sort of a different take than we're already at the we're at either the end of the cycle or a very late stage cycle, and it's inevitable. It almost sounds like, in Druckenmiller, he's not, and Warsh, not always, that certainly wouldn't be seen as a perma bull, and it sounds actually pretty positive overall, which is, he's worried about a policy mistake, not that we're just long in the tooth to begin with.
Right. And so we don't think the Fed has made a policy mistake yet. So we don't think we're in that territory. We do think if you've seen the market flattening in the curve, it gives you cause for concern. But one of the things we like to point folks to is what happened in the mid-90s. And you basically saw the 2-10s curve flat from 250 bips to almost flat in about 2.5 years. You actually saw it drop 100 basis points in about 2 months, a really steep drop. And everyone thought, okay, it's going to invert, or a recession is going to come. But what did the Fed do? The Fed reacted, right? The Fed paused early in 95 and wound up easing later in the year. And that extended the recovery, which had been going on for 5 years, all the way through the end of the decade. And the 2-10s curve stayed between 0 and 50 bips for the rest of that decade. So as long as the Fed reacts, they can continue this expansion. And again, if you listen to all the governors, they are all telling you the same thing. They want the expansion to continue. Some favor more hikes, some favor less, but they're all on the same page that they want the expansion to continue. So while it's later in the cycle, we don't think it's end of the cycle, but we think, again, the significant changes you're seeing in the rate-sensitive sectors make a pause not a bad choice here, and the expansion can continue here on out.
So, Rich, you haven't changed your 3,100 S&P target for next year? You have not adjusted it yet. What does it mean you have not adjusted it yet? Does that mean you're going to adjust it, or you think you're going to adjust it? You do?
I think we need to come down some. The S&P earnings for this year, with mean estimates, have trended down from 179 to 176. We're at 171, and to your other guest point, 2.5% global growth would support at least a 15, 16 multiple. So I think we're going to probably come back on our target to 29.50. That's still with dividends could give us a good year next year. Volatility is here to stay, though. So you need to let volatility be your friend and accumulate names that have good balance sheets and strong product cycles and moats of safety around it. So I think if you have cash on the sidelines, Joe, right now, you can dip in, don't be all in, and look to accumulate names slowly, because volatility is going to continue for a while until the fog clears.